Nela, I want to cut to the chase and just simply say, in the new emphasis on tomorrow's jobs report, what are you and ADP focused on?
Well, good morning. I can't think of a better way to start that conversation with wages. It's all about wages. It's about how wages are driving or not driving in inflation. And that's what we're focused on. It pays to be a microeconomist in a macro world, because when you are, you look at things as a collective of decision makings from small to large firms. And what we're seeing is that timing has been a very important factor in the entire dynamics of the labor market. We are now starting to see more people, at least as according to the August report, enter the jobs market. And we saw a deceleration in wage gains growth for job changers. And I think that deceleration is notable.
Right.
We saw it across all firm sizes because it means that switching jobs is not paying off quite as much as it did this summer. And that might reduce some of the pressure in terms of inflation.
What's the and ADP is wonderful at this. What's the character of the job market differential out there right now? Is it airline pilots? Is it bartenders? Who is the job sector that matters to Nela Richardson right now?
Well, it all matters, Tom, but I think where we are different points of rebounding, right? So the service sector was hardest hit. And so when you look at leisure and hospitality, that's important. When you talk about inflation, though, what's driving inflation is low pay, low wage, low skill jobs. And are we still going to see that bartender or that waitress? Bartenders actually can make pretty good money. Let's go
Yes, they do.
Lower skill. Are we going to see low-skilled, low-pay workers still see gains and acceleration in pay? That didn't happen during the 10 years of expansion leading up to the pandemic. Well, we see it after we get over this hump of getting really back to normal when it comes to jobs and getting inflation down. That's the concern, that low-pay workers won't see the pay gains in the future that they saw over the last year and a half or so.
Nela, given that backdrop, I'd love you to comment on what Michael McKee was talking about, that there's this expectation that the unemployment rate will rise, but just marginally, right? It might peak out at 4.5%, still well below some of the peaks that we've seen in recent downturns. How quickly could that move away from the Fed based on what you're seeing in the micro data?
Well, let's start with the JOLTS, because I think that's important. That was a big number this week to see 1 million fewer job postings. We at ADP actually think that postings peaked this spring, so we weren't surprised to see that decline. So that's the first indicator. The second, this timing issue is really prevalent. If more people are coming back to the labor market because they want and need to work, and yet firms are slowing hiring, that's what's going to cause the unemployment rate to increase. That denominator is really important. It's not the number of jobs created every month so much. It's the number of people entering the labor market right at a time when firms may be slowing hiring. So I'm really focused on the denominator of the unemployment rate.
We're looking at this hoping that we still manage to get some sort of softish landing, but even Fed officials are really pulling back from that kind of language. Nela, from what you're looking at, what kind of downturn are we looking at based on some of the rate increases that are expected and based on the pace of weakening, the pace of loosening of this labor market?
I think you're going to see it different angles. Maybe you could call it a downturn by a variety of cuts as opposed to one big stab. Sorry to be graphic in the morning, but you're seeing interest rate sensitive sectors starting to feel some weakness in construction and manufacturing. If we see inflation really hit pocketbooks and consumer spending, you might see consumer services take a bit of a hit as well. And so all those gains in leisure and hospitality that we've been touting might slow. Professional business services are vulnerable for structural reasons. As fewer people go back into the office, that might change the complexion of like office support jobs. So the economy structurally is also changing at the same time that we might see some downturn dynamics driven by monetary policy. And tracing that all out is very difficult to do.